Welcome to the Tons of Industry Show. I'm catching up with Andrew MAGUIRE. Haven't talked with him for about 10 months here since October of 2017, and I wanted to see how his views, market analysis, and personal portfolio have done over time, and has he changed or altered anything throughout the past 10 months. Obviously, everything being dynamic. We'll be covering a number of topics today, with the highest in priority being the clash between Fed policies of tightening and Trump's wishes of a lower dollar and easier monetary policy. We'll talk about the precious metals industry and their horrendous sentiment right now, the U.S. equities bull market, Knesset stop money, and we're going to talk about a bombshell news from Andrew that he hasn't revealed anywhere else. Andrew MAGUIRE, how are you today?
It's great to be with you, and looking forward to our chat.
Hey, Andrew, let's start first with the currency wars, because the East, the U.S., and Europe are all engaged in this super intensive chess match as to how to run and manage their national currency supplies. The U.S. is the only developed nation that is raising interest rates at an accelerated pace, whereas Germany, Japan, the ECB itself, and others are not. You told me off the air that you want to make a debut public announcement of this topic and something of significance and importance. So the floor is yours. What is your view of the events unfolding right now?
Right. Well, I guess really, obviously scratching the surface here, starting from the top. Look, as a gold wholesaler, and I think this is an unusual view for you, because we operate in the wholesale marketplace, and we get to see things that the paper-centric guys just don't. And if you remember, I think 3 years ago, no U.S. trader was allowed to trade over-the-counter spot gold anymore. It'd be stuck to trading in the COMEX casino, which is a bit like the Hotel California. You can never leave if you're a U.S. citizen. But we can all, and the rest of the world can trade. And, so really, as a wholesaler and a trader, my focus is on how a strong dollar impacts the only true store of value, which is the price of gold, especially as the current emerging market meltdown you were just talking about is creating a spiraling dollar liquidity crisis that sucks dollar inflows into what happens to be the best of all the worthless fiat currency classes, and in turn, of course, into the U.S. equity markets. So we've got a bubble going on here. And, however, just scratch just below the surface, and we can see these central planners' plate spinning exercises are wobbling. And we saw FOMC yesterday. We saw what looked awfully like a oiling of the back door, just in case. And of course, right after FOMC, overnight for us, we evidenced another escalation in the Sino-US trade war, which mid-June morphed into a dangerous currency war. Now, I'm going to bring you some of the view from China. And China, obviously, and this is pretty obvious, China has a massive bilateral trade surplus, so obviously cannot go head-to-head with the US in a plain vanilla war. However, China is playing the long game and has already put all the components in place to internationalize the yuan and to displace US dollar hegemony with a gold-backed currency. And I think that's fairly much, we've seen that. We've seen billboards going up to 3 years ago in China, already intimating that this was going to happen. But really what we've been experiencing since this currency war escalated in mid-June is a tit-for-tat devaluation of the yuan, and that's one-to-one offset the imposed Sino-US tariffs, which by design has brought down the commodity sector. However, during this devaluation process, the most important takeaway is that China has managed the CNY gold peg to within an extremely tight range to commodity exporting countries. Now, maintaining this peg in a very tight range has enabled China to provide price stability to those countries that is buying and exchanging oil in yuan to bypass the US dollar. Now, short-term currency war pain aside, 80-20 rule, Pareto's law, China is focusing on providing yuan to oil stability to the major oil-producing countries such as Russia and Iran, where through the Shanghai Oil Futures Exchange, commonly known as the Petro-Yuan contract, oil producers can lock in a stable yuan to oil price that is instantly convertible to gold. Now, this peg has actually been maintained through this enormous volatility that we've seen in the paper-centric driven US gold cross. Now, if you pull up, or I invite anyone to pull up an XAU, now XAU stands for spot gold, the XAU CNY chart, just pull it up. You'll evidence a very, very tight CNY gold trading range with multiple PBOC interventions supporting CNY gold prices at 82.14. Now, with a very tight managed band since the trade war entered into the currency war stage from mid-June. Now, through this entire trade war evolving to a currency war escalation, we've seen US dollar gold prices crash 11.2% into the January 2017 lows, while the CNY gold cross during the same period has been managed in a very tight 2.2% range. So very manageable for a commodity seller. Now, long before the Sino-US trade war escalated into a full-blown currency war and the potential for an escalation into a military war, which we must not discount, the FX peg versus the dollar was already under threat. Now, China had already reopened the gold window. Now, the SGEI is the conduit to exchange gold in yuan. Now, this is physical gold actually being distorted from the West, which is the UK, US, Bank of International Settlements, etc. Now, how it works is China pays in yuan, which in turn increases the supply of yuan, converts it to gold sourced out of the West. None of this gold will ever be allowed to exit China. Now, this is a clear enveloping horn attack on US hegemony and is hoisting the West on its own petard. And I think this is something which, when you just look at the US dollar gold price and you look at the charts and you look at the sentiment as evidenced by the COT reports, where you have unprecedented size, naked short speculator short open interest, it is really unbelievable as to what a disconnect we're seeing here. And so this petro yuan is just one piece of the jigsaw, and its impact on future physical gold demand is being grossly underestimated. And currently we're seeing, people say, yeah, but look, this petro yuan, it's really, we're not seeing any drama here. Well, no. Right now you're seeing rollovers of the September contract into December, but you're looking at a very stable price. So there's little impact on the gold price as yet. And probably what will happen is we'll probably only end up with about 8 tons of September gold delivered. However, it's the December contract that coincides with the largest gold delivery month of the year. And the whisper has it that this is a potential 1,000-ton gold mallet held over the US head, just as China heads home today with no deal. So what we're saying is this carefully managed tit-for-tat yuan devaluation versus the dollar, it's actually being masterfully capitalized on by China, who, as measured by Swiss refinery backlogs, are sucking up physical in size that will, by the end of the year, witness the SGE gold withdrawals to at least equal 2013 levels, probably top 2015 levels. None of this is visible to the paper-centric market. So really, that's just really, obviously I can go into more detail, but that really give you a high-level view of really what is going on in this marketplace.
So, in other words, the Chinese are not backing off of gold purchases because of lower US dollar prices of gold. In fact, they have their own strategy, their own game plan that they're following, and what is insignificant to them is the dollar price of gold, because they move on under their own clock. Is that what you're referring to in the big picture?
And that's what we're seeing in the wholesale market, and it's not just what is measurable through the SGE. We're also seeing very, very large monetary exports of gold, which never hit the SGE, which would be 400 ounce or 12.5 kilo bar LBMA bars heading out of the London into directly sent into the PBOC central bank vaults, and how that is done, and the reason not reported, because it actually is accumulated by the state-owned banks, And of course, these flows go into the state-owned banks. They're not reported because they don't go through the SGE. They're not being refined into kilobars. However, at the click of a mouse, PBOC can bring that into their gold reserves. And I think that's something, again, which is very much unrealized. And so everything that's reported is accurate, but it's all an accounting game.
Now, Andrew, for people who don't know your story, which made you a YouTube persona and a popular guest on Financial Soldier, could you share the episode of the early part of this decade with us, please, and how you came into the limelight?
Yeah, sure. I think what happened was that we witnessed after the 2008 crash. What really irked us, obviously this socializing of debt, privatizing of profits, and we saw the whole game starting again. So, but as far as the gold market was concerned, what we had was sufficient evidence to go to the regulators and set into the CFTC and to report in live time and on, in fact, through my lawyers, 88 examples of gold. Collusive gold interventions. So basically what we would know is where gold was exactly going to fix in 24 hours. We'd give advance information of that to the CFTC, and then sure enough, it would, and these are all time-stamped, and in fact, I made some of them actually live public, and they're on the internet there for people to Google, but essentially these are all time-stamped emails that said essentially, either through my lawyers or on the internet, that says this is where gold will be in 2 days' time or in 1 day time. Now, how is that possible? It's only possible because there was collusion going on bigger than the LIBOR scandal. So the trouble with that was that this was the too big to fail banks colluding in the marketplace. And I've made it quite public that when I sat in front of the DOJ and presented them the evidence that the CFTC was not acting on all their final take on it was, well, okay, but what about the economic consequences of this? Because this obviously led all the way up from the bottom of the pile to the top of the pile. And okay, we've seen the CFTC in this January starting to act on some of my evidence, which was the spoofing elements, where we've seen people admit to spoofing the market, but really that rabbit hole has not been explored. Yes, we're we're seeing fines being levied, and we're seeing a retreat by these same banks. But essentially, that's how I came to fame. And people ask me, why didn't you just sit back and if you know what horse is going to win every race, why don't you just sit back and just bet on it? Well, because there's a real side to this. The real side is that when you play games in the paper market, what you're doing is you're affecting, and I'm very, very close to a lot of the mining industry, and what you're doing is essentially you're screwing the poor people who pull this stuff out of the ground. And in some cases, we had evidence in 2008 of miners committing suicide, Bolivian miners. There's evidence of it, and that these guys were actually. It's so poverty-stricken when they shut down the silver mines and shuttered them. Literally, silver went down, from 21 to about $8, $8.50. Well, of course they shuttered the mines. And so, these proud people had no job anymore, and there was literally suicide cases. So, obviously you can't sit back knowing this and just and play that game. And so, this is really why I became very, very vocal and very involved in what we figured we would have to do is take control ourselves. And it started with a journey back in 2011 after we walked out of the DOJ, and I met a gentleman by the name of Thomas Coughlin, who I know we're going to schedule an interview with him. And, he had the idea of starting an electronic physical delivery, physical exchange, where you could actually trade institutional grade physical metal outside the COMEX in true allocated physical form globally. And this was the allocated bullion exchange. And so once that had been developed, then on a 7-year process, we then were ready to then evolve this into a new monetary system, which I think I sent you a little 3-minute video of that, of what that sums that up. I hope you can share that with some of your viewers.
For sure, and we're going to talk about that later. You're referring to Kines.money, and it's a very interesting idea and a company in development. Wealth Research Group has been publishing many articles and groundbreaking reports on the uniquely bearish sentiment right now of the COD report, the commitment of traders and the commercial traders, the heavy short positions, and the price drop in silver and in gold. How does this look like from the trading floor where you're at? What are you seeing right now?
What we're seeing is an overshoot, a massive overshoot. And well, as you can see, I mean, really just taking the COT report as it was published last Tuesday. And this is another instance. This is another bugbear. This is something which I'm ragging the CME on. Why is there a 3-day delay between in an electronic marketplace where information is gathered every day and you have a report that is published 3 days later in a picosecond world? Why is it delayed? Well, it's part of an insider run game. There's no reason to withhold that information from people. But taking that information at face value and then note that every single week without exception, the biggest moves of the month happen, of the week, always happen after this Tuesday cutoff. It'll either be on a Thursday or a Friday, usually. And that week for week happens. So, okay, so let's just look at it. What we're seeing here is an unprecedented naked short paper market positioning in both gold and in silver. None of this is deliverable. This is pure synthetic gold and silver generated on a 4% margin, and you don't have to have any physical in your possession to be able to sell this short. So what is created is a massive overshoot. And so obviously it's very easy to target technical levels where all you have to do is look at a chart, and as a trader we know if it goes below a certain spike or above a certain spike, there's going to be stops, whether it be long stops or short stops above that level or below that level, and that's what's been happening. There's been a targeted move. Now, I think obviously this is where we get into the disconnect perhaps between the dollar and there's obviously there's a dollar gold correlation, and we've been talking about this liquidity squeeze in the dollar. It's created a massive run into the dollar, which then triggers. We've got a 95% algo market here, where there's no brains are involved anymore. It is simply correlations, and so you see the dollar go up, and instantly you got an algorithm that says sell gold. So this is obviously these algorithms change over time, but there are times when gold and the dollar trade in tandem, and we haven't seen that since 2004 to 2006. But we're probably expecting to see that again. But this sentiment, of course, is in the tank. So, but this is a US-centric view. Look in any other currency, any other gold currency that is. Would you really want to be in cash in Venezuela right now? Would you want to be in cash in Turkey right now? I mean, really, and we're seeing, and I've just gone through an explanation of how China is managing the gold price in their currency into a very tight band for other strategic purposes. So this US-centric view is going to change. And especially as we see from a wholesale perspective, there is no longer do we see the liquidity really, we see liquidity flowing out of the paper markets into the physical markets long ago. At least 2 years ago, the physical markets were established in the East. That's China, that's Hong Kong, that's in Asia, where the physical markets are. Where if you want to sell gold or silver, you have to physically have deposited it first. You can't just promise to deliver it. You put your gold or your silver, it could be the same in the ABX exchange. If you want to sell your gold or your silver, you better have it in the vault. Otherwise, you can't sell it. And this is the difference. And what we're seeing is the breaking of a paper market as its liquidity flows into the physical markets we're going to see this COMEX marketplace start to splutter and run out. And it's simply is something that we're witnessing. And yes, it's been an incredibly slow process. And people just looking at the US dollar chart have a myopic view of what's really happening in the wholesale market. As I say, we have Swiss wholesalers backed up since May with Chinese demand, and that's just kilobar demand in 15-ton tranches. And yes, we don't see that in the refineries in Asia. Why? Because this gold is coming right out of London, out of the BIS, out of the US, through London into Switzerland. So it's a wholly different view, and it's really a myopic view.
Sure, and I think one of the things that are important to understand is when you own gold, in order to capitalize on geopolitical events, you have to keep an international mind as well. In other words, if the price of gold drops in dollar terms, but there are opportunities to take advantage of geopolitical events in other regions of the world, that is something that a gold investor should be able to do. It should be in his sphere of competence. If he only invests in gold as a hedge for a fiat currency crisis in US dollars, that might take a while, obviously, because the dollar is the most robust currency on the planet. Being 6 out of every 10 currency units, it has less crises than other fiat currencies. And as you said, if you're right now in Turkey, and if you're in looking at Turkey, at the Turkish market or the Venezuelan market or other countries that have a weak fiat currency, that is where the dollar, the gold can come in to your benefit as a international-minded investor. And I want to ask you, Andrew, Trump has been the first president in decades to openly make his opinion known regarding his feeling of central bank policy. He wants to keep interest rates low in order to help U.S.-based exporters. The Fed is asked to remain independent in this process and pursue their own mandate. Is this truly a new precedence that President Trump is setting by questioning the brains behind the Fed and openly making this a public question that could be, debated on mainstream media and on alternative media?
I totally get it. And do you know what, Lior, this is something that it really cheers me up to see the these plate spinners starting to wobble their plates. I mean, really, this is a president that is not going to back down. No matter what he does, whether it looks like he's winning or losing, he will not back down. Now, if he wants a lower dollar, he will have a lower dollar. And whatever it takes to do that. Now, he's chosen a Fed chairman here that he thought would continue to toe the line, so to speak. I'm sure they had discussions on how it would play out, but he's not very keen on any more rate hikes. He doesn't want a higher dollar price, as you've just pointed out. And really, what we're now seeing is that in retrospect, with especially, I mean, let's look at the main driver here, which is what we've discussed slightly a little bit while ago, is this Sino-US currency or trade war that is turning into a currency war, and obviously, this has caused an emerging market meltdown. Which has caused this liquidity squeeze in the dollar, which is driving the dollar higher. That's exactly what Trump doesn't want. So is inverse to his goal. And this could bring down the stock market. And I think, and he was talking today about, it's quite clear that his motivation is to keep the stock market strong and the dollar weaker or competitive. Let's put it that way, comparatively competitive. And he made a statement today: if you impeach me, the stock market could collapse. Well, quite clearly, it's his mandate to keep things bubbling along. So if he wants to change something, he will change something. And I don't know how that's going to play out, but I'm sure as hell glad he's ruffling some feathers out there.
True, and obviously that's why he has been voted. That's his political capital to bulldoze traditional policies and pave a new road for the U.S. Obviously, we're living in a new world. This is not what 2008 has been all about. It's completely different, and one of the key lessons to understand here is that the Chinese, the Russians, the countries that used to own the majority of the debt, the treasury debt, have not increased the levels of exposure they have to U.S. debt. They've remained probably the same from 2008 till today. They've allowed the Federal Reserve to monetize and buy treasuries on their own, but they haven't done that. They're completely different economies. Obviously, China is becoming a consuming economy, not an exporting economy. They're much more robust and much wealthier. It's going to be a very different environment. In 5 to 7 years, they're going to have the biggest GDP on the planet, and in about 20 years, they're going to have the biggest military. So we're transitioning into a new world, and I think this is part of the currency wars that are going on right now. I want to shift topics with you and ask you about Kinesis.money, the company you're involved with, and can you share with us what the company does and what's the vision, what's going on with everything that has to do with this brand?
Yeah, Lior, and again, this is something, and this is the involvement of the story that we began earlier, which is basically taking control. We have a broken banking system, and we've seen decentralized currencies pop up, the Bitcoins of this world and the Ethereums of this world. Why? Because people want out of the system. Now, however, it doesn't solve all the problems. Now, the Kinesis monetary system is actually the game changer that we've all been waiting for. And I'm really so proud to be associated with it. I 1000% put my name behind this. And as I say, I sent you a link to a world-class 3-minute video that kind of explains Kinesis extremely well. But I'm going to keep this really high level. And I know that we've scheduled Tom Coughlin to come on a show at some point in the near future to really, drill down to this exciting monetary system. But I'd like to encourage, as you say, listeners to visit the Kinesis.money website. Really what I'd like to say, in a nutshell, this is one-to-one gold and silver-backed currency that circumvents this broken banking system. And I see Kinesis as not just providing the store of value and medium of exchange solution that will allow the remonetizing of physical gold and silver, which to me is the nirvana of this. It will also put an end to the seemingly eternal synthetic gold and silver wash and rinse cycles, which we've just been talking about. And it's much more of it takes gold and silver back into the monetary system. This is a global world. Now, Kinesis puts the aggregated power of physical concentration back in the hands of us, the people. Now, so why speculate in paper gold and silver when you can own real physical gold and silver and earn a perpetual multifaceted yield? And each of us using this Kinesis currency becomes a solution, and to play our part in ending this paper sham. Now, everywhere we look, whether we're individuals or the largest institutional entities, we are all exposed to counterparty risk. Every financial asset we own or think we own is exposed to this counterparty risk, including the fiat currencies that you've deposited as a loan to the banks holding your named bank accounts. And so, and this is something that it cannot be ignored. There is $250 trillion of global assets that have zero intrinsic value. And we're talking about your cash, bonds, shares, paper claims on physical assets such as gold or silver are included in that. And we have, 32 or 33 trillion of M1, which has zero intrinsic value. So everything, of course, that we just mentioned has utility value, but zero intrinsic value. And that's all well and good if there was trust in these central planners we were just talking about. And these guys, it's become far too obvious that the wheels are coming off this wagon. And as a result, we're seeing increasing efforts by individuals, and that's fund managers that we speak to, corporations, and indeed entire countries to hedge this risk. And we're seeing that with China right now. And there is empirical evidence that physical gold and silver is being sought and removed from the reaches of central planners who are undoubtedly themselves eyeing a gold revaluation as the only possible solution to reset a broken system. And we're seeing delivery failures or withdrawal limits imposed and what we call delivery failures in Switzerland, where you have a 0.75% negative interest rate, and yet you cannot remove more than 100,000 euros per year, whether it be cash or gold. I mean, so, again, Hotel California, you can't leave. And so really, this is what's exciting about this. So many people have lost faith in the system, and they're pouring billions of dollars into decentralized cryptocurrencies to escape the tendrils of these central planners. And we've just named two of them, Bitcoin and Ethereum, but because everyone's heard of them, but none of these cryptocurrencies they all have utility value, much like the intrinsic value, the lack of intrinsic value in these $250 trillion of global assets, but nevertheless, they have zero intrinsic value, these other cryptocurrencies, and they are a welcome alternative to the legacy banking system. But this is the important thing. They don't solve two of the three elements required to be a sustainable global currency. They provide a unit of account, which is great, but fail on the two most important elements: to provide a store of value and to be an efficient means of exchange. And furthermore, this is a currency that defeats Gresham's law. I mean, if you're incentivized and you're receiving a share of the transaction fees as opposed to spending your debt-based fiat currency where you receive nothing back, and you get a share, essentially you're getting a share of the transaction fees through the system. Therefore, it equates to a yield. And, so this is the only monetary system that addresses all the factors that have held physical and gold and silver back from acting as money. And by attaching a yield to gold and silver, it incentivizes its movement as a currency. And by putting a fully backed gold and silver on the blockchain, it enables this efficient means of exchange. Now, this is a system of individual and collective shared wealth that is diametrically opposed to the debt-based central bank to central bank Ponzi scheme that we currently see. So, and people ask, well, yeah, but how do I know this is just some ICO that's just about to be launched on an idea? No, this feeds in from we talked about the establishment of the allocated bullion exchange. That's nearly a decade in existence already, unblemished record. Kinesis was born simply from ABX, and which is the world's leading institutional exchange for allocated physical precious metals. Huge institutional trading going on the ABX, and it has and ABX has partnerships with Deutsche Börse, government postal systems, and many others. So we have adoption already. So the Kinesis physical metal holdings are held inside of an established, secure ABX quality assured environment and always titled to the client's name. And that's a very important point to make. At no point does the gold or silver running through this currency monetary system sit on the balance sheet of either Kinesis or ABX. It always remains in the client's name, and they can take delivery of this gold or silver or spend it at any time they want.
Now, Andrew, in your expertise, can any single institution cause the silver paper market to be cornered, to collapse, to unveil the massive leverage? Why isn't any trader or investor trying to capitalize on the obviously evident leverage?
And again, we come right back to where the synthetic supply, where the price setting is occurring in the COMEX markets, and this is the transition now that we're talking about. So, really, if you have one particular institution that is really controlling the bulk of the action, even if it's just two institutions, but largely just one, controlling the trading of silver in a synthetic marketplace, then what you have is simply position concentration. Now, position concentration in the oil markets, the grain markets, or any other market would be immediately jumped on. Yet we look at position concentration as based on the COT report, and you can clearly see there is actually, and if you then take that COT report, which is designed to not be fully transparent, and then you connect that to the bank participation report, you then look over to the Office of the Comptroller report, and it becomes very, very clear that one bank, and in the past, we've had one bank. And if you go back to 2010, 11, 12, you'll see that JP Morgan had 99.8% of all derivative positions. So, and that includes gold and silver, and that's specifically silver. So, but gold and silver. So now, having accrued, one particular bank having accrued such a large concentrated position, even if they had a physical to back that position up, which many people dispute, but let's not get conspiratorial here. Let's just say there's a physical silver position sitting somewhere in the range of, say, 700 tons. It's not the issue. The issue is that you have a concentrated position where you can actually use that concentrated position to target your own client book. If you're a market-making bank, you know where all the stops are. You can run the price of gold and silver to any price you wish. Now, obviously, running it down lower is a great advantage because you can continue to accrue large physical supply without it being apparent. But what you're creating is a massive disconnect between the paper and the physical market. And I think there are plenty of other people that I know are capitalizing on this. Right now we see, we fill plane loads of silver to India. A plane load can take 20 odd tons. We see plane loads of silver headed for India. We're seeing large quantities of silver being absorbed into China. This silver is recognized as money in these countries. We see it as virtually a dot on a screen that could be zero. As far as most traders are concerned, they literally have no concept that there's a physical actual side to this market. So it's all about position concentration, Lior, and that's all it is. And that's going to end up in a massive move higher at some point when this thing cannot be settled for cash.
Now, Andrew, where can people check out more of your work, follow you, your social feed, and your website?
Well, I'm on Twitter. And at Andrew Maguire 1, but I would really ask people, because I'm so passionate about this. This is a monetary system that is going to change everything, and I think if people go on to the Kinesis.money website, have a look, drill down, have a look, ask questions. There's a Telegram group they can join, ask any question you wish. And there's somebody that will be there to answer those questions. I think it would be really important, and especially as we're now seeing central banks starting to recognize the fact that they are needing to get into this world. And what we need to do is keep it decentralized. These government, we saw the Bank of England Governor Carney this week coming out talking about, hang on, we best not ignore this cryptocurrency thing. Maybe we can let's make sure it doesn't get away from us, kind of thing. And I've got all his notes here, but what he's saying is these bankers want to hijack and centralize the crypto ecosystem and shackle it to debt to keep the Ponzi scheme going. We need to keep it decentralized. We need to keep it peer-to-peer. We need to make sure that people have power in their hands, and we need to take this power and put it in our own hands. And this is why I'm so passionate about the Kinesis system, and I want people to go and look at it and take this opportunity to use this as their currency rather than a debt-based currency.
Andrew Maguire, thank you very much for taking the time, and we'll definitely have you back on again.
Look forward to it, Leo. And if you wish, Tom Coughlin would be very happy to come and give you and your listeners a much deeper trip into the Kinesis world.
We'll definitely set it up. Thank you, sir.
Thank you, Leo.